It is impossible for an accounting firm these days to stay independent with the onslaught of mergers and acquisitions and private equity money and technological disruption. There is no way firms can make it on their own. Gary Shamis, you analyze these things. Is that true or false?
Well, I hope it's false, because if it's true, I probably know because I work mainly with independent accounting firms and trying to make them continue to be independent and to prosper.
Is it hard, Gary, these firms to resist the temptation to sell out, if you like?
Yeah, it's I've been calling it like opportunistic greed
Yeah.
management. And you know, I think we're going to talk a little bit about what I think firms have to do to stay independent. But one of the things that I'm going to start with, I'm going to talk about alignment, and then you have to have your partners aligned and all your partners rowing. Now, it doesn't have to be 100%, but it's got to be consensus. Try and run a firm where half the people want to sell and half the people want to stay independent. And what'll happen is every move will be scrutinized from then on. Oh, we should have done this and we didn't. So those kind of things. But just imagine this in alignment. And this is U.S. based. I'm not sure exactly what it may look like in other parts of the world. But you're going to retire. You were making $500,000 a year. 25% of that is what is going to be paid to you, and with respect to deferred compensation on a 10-year go forward. So it's $125,000. It's 10 years. You're going to get $1,250,000. Generally, the way that's structured in the U.S. is it's ordinary income. It's deductible to the CPA firm. And you, as the retiring partner, will get $125,000, paying maximum rates, no guarantees on the payment, and really nothing to mitigate your risk. And then all of a sudden, private equity comes along and they say, hey, Mr. Retiring Partner, instead of the deal that you have in front of you, what if we were to give you $2 million instead of $1,250,000 over 10 years? You got it all today, and we could arrange for you to have better tax treatment on those dollars. So it's like a gift.
It's a no-brainer, Gary, isn't it?
Well, it's not a no-brainer, but it's very tempting, and call it opportunistic greed. That's what I kind of called it, and it's very tempting. There's other concerns. You spent your whole life at this firm, and there's people who got you to where you're at, and how you're going to treat them, and what's the right thing for your clients. So there's all these other things I think you have to take into account when you make that evaluation. But from an economic standpoint, it's pretty clear that's a better deal.
Well, let's deep dive into this. We talk about the path to independence, and you talk in your body of work about having a minimum here. What needs to be in place to stay independent? Just talk us through some of the considerations here, Gary. You've mentioned partner alignment, but just take us through the stack, if you like, of minimum requirements to stay independent.
So if you go to Las Vegas to gamble and you go to an expensive table, they're going to have table stakes. They're going to say, hey, if you want to come to this table, you got to add.
Yeah, you got to get in the game with something.
Yeah. So I'm going to tell you what I think are the 4 table stakes. I want to tell you that about 6 months ago it was 3 and now 4. But if you want to stay independent, I really believe that firms have to look at these 4 elements and judge themselves and see whether or not they can be successful. And if not, maybe they have to try and fix it or be realists, and maybe also at the same time say there's a huge opportunity here because maybe I have a damaged firm and somebody wants to buy it, so maybe we should be.
Okay, so what's table stakes number 1?
Number 1 is alignment, which we already talked about, having your partners in alignment, your partners all rowing in the same direction. I could just showed you how easily that can come out of alignment, and then generally what's happening with senior partners retiring. Last time they're going to be able to make any money in their lives, probably are going to retire from them, and all of a sudden they have a much better economic deal. So easy for them to get.
But Gary, just on partner alignment, I was chairing a conference just last year. Mark Koziel, formerly of Lineal, has now moved to head up the AICPA. You'll know Mark very well. He said the managing partner model is dead simply because partners cannot be managed. And that's a good point, because getting alignment in partners, getting them all on the same agenda, when they're at different stages in their career, they have different packages and comp structures. It's so difficult, isn't it, even to get this first table stakes right?
Well, that could be a whole other discussion on that. But I don't agree with that.
Okay.
And, when I had my firm, we had an outside advisor, a guy named Dick Pogue, and I talk about him oftentimes in my most recent book. And Dick was the managing partner of Jones Day, which turned out to be one of the largest law firms in the world. And he sat on our board. I used to ask him for advice. And And one of the things he told me is that you have to run it like a business. Okay, so take away that partner model. And the other thing you have to do is your partners have to really be focused on really three things and three things only. And if you think about it, all these people who are partners, they didn't join CPA firms or they didn't go into the accounting profession to become partners. They initially went into the accounting profession to become accountants. And a lot of them don't have that skill set. So the way he looked at it and the way we tried to really organize my firm was really having partners do three things and three things only. Partners were in charge of growing their practice, servicing clients, and growing people. And that was our focus for clients. Let me run the business, let our C-suite run the business, but you do those three things and you do them well and we'll be successful. And that's really what that's doing, is taking away partners from the decision making, from entitlement, in terms of being a partner and making decisions. And we're saying, no, just focus on what you can.
Okay.
So alignment's
Got
number
it.
one. Number two is you have to have a succession. In the United States, people were saying, oh, you have to have a bench. Well, and I don't, you probably have a lot of soccer listeners. People on the bench don't play. You don't need a bench. What you need a farm team below the bench with a lot of people who could rise up and take the place of players. So you cannot go forward unless you have a group behind you in order to succeed you moving forward. And obviously in the U.S., that's one of the challenges today with the fewer people going into the profession, not as many people to take those places going forward. And that is really what's really stirred up a lot of the problems in the United States, is not having enough accountants to succeed the profession. But within your organization, realistically, do you have the people in place to allow this organization to continue going forward? And if you're also thinking in terms of paying out former partners, that could be a long-term 10-year deal, and you have to have people in place to be able to do that for the next 10 years. So do you have a succession? And it's just not the managing partner. It's your audit partner and taking care of clients and, wherever else you have key people, you have people to succeed them. Number three is leadership. I certainly like talking about leadership because my organization that's what we do, leadership development. We've trained 200 managing partners across the globe to run CPA firms. But leadership has never been more important. You need leaders that have skills that they probably don't have going into leadership. They have to motivate people. They have to people accountable. They have to strategize. They have to look around corners, and they have to deal with so many things. So organizations that don't have quality leadership are going to be very challenged going forward because of everything that's coming their way with respect to change. So that's very challenging. In the last couple of years, I have run into a couple of firms that I have been working with, and the ultimate suggestion was they didn't have that table stake. They didn't have that next generation of leaders, and led to both of those firms being transacted to firms larger than had leadership. And then the last element I'm talking about is I'm calling it a recalibration of the partner buyout. So, and this kind of ties to the alignment. So clearly today, these firms are valued at higher values than they were years ago. Why? Because private equity has upped the stakes. They're offering more to buy these firms. So you're a partner with one of these firms. You're about to retire. You spent your whole career there. Why should you give a discount when you could get a more equitable value from your firm going forward? So I think firms have to really look at how they're paying out retiring partners to make it more competitive with the market. But that has a slippery slope to it, or it has consequences. And the consequences are if you have to pay the retiring partners more money to make this work and stay independent, then there's less money for the existing partners. And that doesn't work out too well. So the consequence is you just have to be more profitable as an organization. So you can unpack this whole thing in terms of recalibration, in terms of paying more to retiring partners and making accounting firms more profitable. You have to do those four things, and if you can't do those four things, I think you're going to be very challenged being independent. But those are just table stakes. Those are just to get you to play the game. After that, there's a lot more.
Well, you've really set the benchmark there for what needs to be in place to resist the temptation for independence. I'm going to ask you in a moment, what are the winning strategies for the independent firm, Gary? But let's just go to those situations. I'm sure you dealt with them where firms sell out, but they shouldn't. They didn't need to, but they they bought the buck. They were lured in by the attraction of PE money and change and everything else, and perhaps it was the wrong decision for them. Have you got any scenarios like that? How does that play out?
I'm chuckling because the scenario that plays out the most is me selling my firm.
Okay.
I sold my firm to BDO. BDO was 104 years old. It was the largest transaction in their 104-year history when we sold to them. So it was a big deal. Personally, and most people know this, I didn't want to sell. I loved my firm. I loved what we were doing. Thought we had a bright future. This opportunistic greed showed up. BDO made us a very formidable offer. Some of my senior partners are looking at the formidable offer versus waiting over 10 years to be paid out, and they really pushed the deal. And I didn't really expect it to happen, but it
did. You resist it, Gary, at the time, even though it was all stacking up for the other partners?
I did resist it, but kind of like this alignment thing. I could have stopped it, but if I would have stopped it, anything that would have happened after that moment in time could have been judged. Oh, we should have sold. Why didn't we do this? We're getting sued. We should have sold.
You can't win there, can you? Really?
I was really in a bad decision, and also I was at a point that I was only a couple years away from retirement, and I really felt, is it my responsibility to go and really carve other people's careers going forward by making a move myself? So from my perspective, I don't think it was the right thing to do. I brought 33 partners over with me to BDO. Today, there's 2 left. This is 10 years later. And the clients weren't a fit. Now, BDO had its reasons, and I think BDO was probably happy. We were in this, we had the largest firm in the 7th largest state in the United States, and we had some verticals that were very popular, or it looked like they were very opportunistic. And, they wanted to be in Ohio because it was a big state, and the kind of work they did, there was a lot of opportunities they weren't seeing. So I think they had the reasons, and I think from their perspective it worked okay. But in the reality, I think I'm pretty sure it wouldn't have happened like it did, being able to look backwards on this thing. So do I see firms do that? Yeah, that's really concerning to me today. And I do see it, at least from my perspective. I see firms that have great futures that are selling out today. And when you sell out to private equity today, in most cases, they want a majority position. So what you do at that exact point in time, when you sell to them, you limit your upside. You may only own 15 or 20%. But if you have an organization that has huge upside, you're giving them the upside. You're not keeping it for yourself. So things like that you see often. And also bad fits, fits from a cultural standpoint that just aren't going to work.
Gary, why do firms feel that they need the equity, the injection? That's such a big sigh there. You've pondered this for a while, haven't you?
Well, do they really need the injection? Right. And I think that is being so oversold, in my mind, that they need this injection of capital to be competitive. Okay, so where do the firms spend their money? Most of the money they're going to spend is going to be certainly on people and technology. Well, I would argue today the technology is cheaper dollar for dollar than it was when I ran my firm 15 or 20 years ago. You get a lot more bang for your buck. In all the years I ran my firm, do we ever need outside dollars? No. What we did is we would have partners maybe make a little bit less money, reinvest that into the organization. The only place today that I see that really the need for capital would be on a growth strategy. And 2 reasons. Number one is because in the past you didn't need cash to buy a CPA firm. Now you do. So how do you get this cash if you're a firm and you have limited availability? And then the second is if you want to grow into advisory and buy an advisory firm, it's not going to be cheap. So from a growth strategy, I could see potentially the need for capital going forward. In terms of shoring up your business and making investments into it, I'm just not sold on that.
So we're at a situation now. We've got table stakes. Some firms are really fighting hard to stay independent. Private equity seems to be everywhere, and there's so much consolidation going on. Talk to us about some of the winning strategies for staying independent.
Important, top of the list, capacity without people. How do you get the work done? There's more work, more regulation, continues, less CPAs. So it's a tough balance. So I think firms are very challenged with respect to being able to grow capacity within the organization without doing it in the traditional way they did. Four levers. One lever is outsourcing. I think firms have to outsource or insource. Years ago, Thomas Friedman wrote the book, The World is Flat. In the first 100 pages, he talks a lot about that. And I think he really, he nailed it 25 years ago as to the necessity for doing that. The second is process improvements. What are you doing in terms of process firms are really good at adding process, but most firms don't spend any time reevaluating process and taking it away. The third element is just hiring and retention. Do as best you can, keep the people you have, be more competitive on hiring. And then the last element is practice management, which is really stop servicing clients that aren't a fit. Small individual income tax returns, small businesses, people who don't pay their bills, people who treat your people badly. I mean, why are you doing work for them? Get rid of them and create capacity for yourself. So that's one. A second, to me, is building an advisory practice, trying to create more value in the relationship. And, every firm has to look at that differently because a lot of that's going to be based upon the DNA of your firm. If you don't do any restaurants, why are you going to put in a restaurant consulting practice? If you do restaurants, why wouldn't you put in a restaurant consulting practice? So, and then there's some things that are generic that fit almost any firm, like wealth management and payroll and maybe cyber work. But I think firms need to create more value. And from a historical standpoint, when I built my firm, that was a lot of our philosophy. And what we found out, which I like to talk about, is that when we sold our firm to BDO, they didn't buy our other businesses. And when we ended up having to sell our other businesses because they didn't buy them. And the mothership was gone, being our firm and supporting them. So we decided we have to sell them. And on a relative basis, out of all the business we sold, the business that had the least value was the CPA firm.
Wow.
The payroll company was worth more. The wealth management was worth more. The healthcare consulting company was worth more on a relative basis. So, we used the mothership, the advantage of owning the firm to build some very strong businesses and also some that were very profitable. For my 33 partners, we moved over millions of dollars of profits from those other companies back to the CPA firm on an annual basis, which spiked the earnings of our partners, well beyond what most people were because of our investments in these other businesses. So building an advisory practice going forward. And, there's different strategies how to do it. You can buy it, you can partner with people, you can build it, but I think actively building one is really important. What else?
Well, I've got the slide up here, Gary. I'll put it on our YouTube video as well so people can see it because this is stuff you do day in, day out. Let me bring up a couple more. You've got growth at the top right here. So that's a good barrier to independence, isn't it?
Well, it's growth. And, why is growth important? From my perspective, the reason growth is important is because this is a people business. And you need talent. And you are not going to get world-class talent unless you have a growing organization. So growth is really important to attract the kind of talent you need going forward as an organization. Help me, Rob.
What else we've got? We've got culture on here. Talk to us about the role of culture, Gary.
Yeah, culture is really important. And, I talk a lot about culture today. And this really kind of goes back to this element of leadership. And, why is culture important? Because culture in the past was a byproduct. And it was a byproduct of the partners going into an office and having everybody within these four walls. And maybe there's multiple locations. So culture just happens. And if you had nice people running the firm, you probably had a nice culture. And if you had people who were really difficult, you maybe had a difficult culture in the organization. But what today is, culture is so influenced by outside perspectives that it has to be intentional. You really have to think about it. And what are those perspectives? Well, one of them is virtual work, and virtual work in two ways, allowing your people to go home and work. And the other is during the pandemic, how many of us hired people in different states or different countries to do work with us, and they're not in those four walls? So that is certainly an element. There's a big chasm between the baby boomers and the millennials and the gens in terms of what their expectations are in work-life balance. Also, with the outsourcing, you have people who have different cultures, speak different languages, have different holidays. So now you've created this whole dynamics of so many different influences into a firm's culture. It's like, well, what is your
Yeah.
culture anymore? So I see firms, some firms have done it incredibly well. I think Aprio is one who's done it incredibly well, is taking this culture and moving it through the organization intentionally. And that you may need a little help to do that. You may need some outsiders to guide you through that.
There are some good people out there. The challenge I see with culture often, Gary, is some firms are acquisitive, so they will stay independent in and of themselves, but they'll acquire the smaller firms. And then you're introducing all those smaller micro cultures into your firm and different offices and locations. And it's hard to get a harmonized and defined culture, isn't it?
It's very hard, and that's why it has to be intentional, and it never was before. So, on top of all the other things we're dealing with, we have to throw that on the list, and that's a really big element.
So we got growth. If you grow, it's easier to stay independent. You got capacity without people. If you're intentional with that, it's more likely you will stay independent. If your culture is intentional, you'll do well there. And if you can add on or acquire some kind of advisory practice, you will do well. We've got three more we're going to look at, Gary. Strategy and execution. Tell us about the importance of that in staying independent.
I teach a course at Managing Partner Bootcamp, and that's my favorite course I teach. And at the course, what I do is I talk about strategy, and I talk about how strategy in the accounting industry is so easy. And what do I mean by easy? Well, it's not a secret. And if you look at the strategies that the big four are using or larger firms are using, nobody hides their strategy. There's nothing out there that somebody is, so innovative. And a lot of that is because we're really in a regulated industry, and there's only so much you can do. And sometimes the strategy ends up being around the industry, not within the industry. So what do I mean? I mean things like marketing and your human capital, the way you treat them. Strategy isn't hard, but what is really hard is execution. And in order to really do anything on the list that we talked about, we have to be able to execute as an organization. I am really somebody really big on the fact that people who are running these organizations have to have the time to do so. Certainly, smaller firms are very challenged because the people running those smaller firms are also people producing revenues, and because of that, they make the economics work. But when they don't have the time to invest to make change and execute change, then they just don't change. So, there's a certain point, I don't know where it is. I don't know if it's a $10 million firm or a $12 million firm or 15, and every firm's going to be different. But at some point in time, you have to really have somebody focusing on the execution of change in order to move organizations forward. So everything that we talked about today, it's just not going to happen. It only happens when someone's going to work on these things. So it's incredibly important to have strategy and execution.
One of the problems with execution, Gary, is decision making. It's death by committee or trying to get consensus on any particular thing. What's your take on that?
Well, that gets back to what we were talking to before. Is you just can't let. There's a point in time when the partnership model doesn't work because you can't make decisions, and you have to really evolve from the partnership model to a corporate model. That's a big decision. And a lot of firms fight that because they think there's this level of entitlement as a partner. I became a partner, so I can decide, what color the wall should be. And it's like, you don't need to waste time on that. Do those three things well, let somebody else run the firm, and you'll be far more.
Yeah. On your list of 7 winning strategies for staying independent, and I'm really glad you got this one down, it's change management. We're in such disruptive times. There are so many drivers of change that we can't keep up. So talk to us about this one, Gary.
Well, you have to have a firm that's very nimble. When I went to BDO, and understandably, I don't know how many, 20, 30, 40,000 employees, it's hard to be nimble. I'm sure most of your audience is in a position that they can be nimble. And that is such a positive attribute to have as an organization, your ability to be able to be nimble. But in a leadership position, people have got to understand that things have got to change, and things are changing so rapidly. If you just look at the business versus 10 years ago, it doesn't look the same. And especially with this entrance of private equity, I'm not sure what's going to look like in 10 years as well, too. So firms that are just like, we're going to do it the way we did, if they're not going to last, it just doesn't work there. Just to give you one quick story. When I first started this consulting firm, I got called by a firm, and somebody I'd known. They had 3 partners. They were an incredibly successful firm, incredibly successful. They worked really hard. They were in a small town. They probably were the wealthiest people in the small town because they ran this organization so well. And the phone call I got from them was, "We don't know what to do. Can you help us?" Well, what happened? Well, what happened was our three younger partners to take over with us have all left the
Whoa.
firm. Well, why did they leave the firm? Because of the culture of the organization was one they didn't want to work in. They were looking for work-life balance. They were looking at what was ahead for them, and they said, "I didn't want to do it." So I met with their firm, their managing partner. We're having the discussion. I'm telling him, you just have to be nimble. You have to change the way your organization. You're not going to attract people. And I remember him taking his fist and slamming it down on the table and saying, "You know what? I'm going to find the people exactly like us, and we're going to continue this organization as is." So, and what's where did that lead to? The fact that they're no longer in business
Wow.
today.
Well, that's change management. Last one on your list, Gary, is firm and partner goals. You've spoken a little bit about this, but just wrap that in a bow for us so we can put this to bed.
Yeah. So, I wrote an article, and I have another one coming out. Hopefully the Journal of Accounts is going to pick it up. It's like a similar article that I wrote about 15 years ago. I wrote it with Jay Nisberg, and something that used to always bother me, still bothers me today, is how do we judge success in firms within the United States, probably within the world, and we use one metric to do that, and the one metric we do to do that is size. So if you look at the top 100 firms, well, to use the word top 100 firms, are they the top 100 firms?
Really?
Now they may be the largest firms, but not
Yeah,
the top
true.
100 firms. So that used to really bother me, because I'm aware of CPA firms that are amazing CPA firms, and they do amazing work based upon what's important to them. And some of those things, because of their status in the organization, could be becoming a corporate citizen, okay? Giving back to the organization, giving incredible service to their clients, and these things that are really important. And I think it's really in our best interest to understand as an organization what really is important to us and be sure that we focus on those things, just not focus on getting to the top 100 list, because that's not necessarily, the place you should be.
It's a vanity metric, that one, isn't it?
Yeah.
Well, Gary, this has been amazing. Just visiting the topic of independence that we don't talk about very much, but for our audience here of accounting leaders and emerging leaders, it's good that they know about this stuff and they know what is at stake here with staying independent, and if they are going to take the private equity money or do that M&A activity, what the cost will be. What closing remarks would you give to the leaders listening, Gary, for them to take what you've done and be more influential as individuals and have more of a say in the firm and take the firm in the right direction and make good decisions around independence?
Well, it's a good word, because I'm going to take that word and say I'd like to have them think more independently. Yeah. And that's really kind of what it gets down to. I've been in this business a really long time, and and I would characterize this as a business of followers, not leaders. And what happens is when one goes private equity, they all go private equity. When one starts outsourcing to India, they all outsourcing to India once you open the doors. I saw that with my managing partner boot camp when we first started it. I'd never done it before. We got 9 people to go. 9 people led to 20 people. Now we have 200. I show my list of 200. Oh, it must be okay, and do it. So I don't think firms think independently enough about the things we talked about, who they are, what they expect, where they want to go. How does this really fit them, their clients going forward? And I just think firms just need to spend a little bit of time, on a self look at themselves in terms of how they go forward and try and think independently about pretending to stay.
Yeah, that's really good. As you were talking, I was thinking of the phrase gold rush. There's gold and then there are hills. And once you get a few trickles of foot, it turns into a stampede, doesn't it? And everyone's doing it. And it's hard not to get caught up in it.
It's opportunistic.
Yeah. Well, on that note, it's a lot for our leaders to think about, but stay independent, scrutinize decisions, and practice discernment. That is the way forward for today's accounting firms. Gary Shamis, we will see you on the next episode where you're going to talk about the current state of M&A and accounting. That is really important for our leaders to listen to and apply. Thank you so much today for talking about whether independence is still an option in today's world of accounting.
My pleasure.